Right, so good afternoon. My name is Ala McCoy. I am Director of Startup Support at University of Maryland's Ventures. And I am very happy to welcome Professor Samuel Handwerger from Robert H. Smith School of Business, who will be talking to us today about a very important issue of taxation for startups. Not something that is not something that startups usually think about, but a very important issue nonetheless. So thank you so much, Professor Handwerger, for joining us today. If you would like to take from here, talk a little bit about your background, and then share your screen as you wish. I'm going to mute myself and turn my camera off, but I will be monitoring the Q&A. And so feel free to submit your questions and they will be answered. So thank you so much. And you can take the microphone.
All right. Thank you very much. It's a pleasure to be here to see all the students interested in entrepreneurship, as very dear to my heart. I graduated from Maryland many years ago. Then I went out into practice in public accounting, got a master's in tax along the way, and have now, for the past 7 years, returned to the scene of the crime and teaching at the Smith School. It's been a pleasure. It's a really great school. Maryland in general is a fantastic university, and I'm happy to join with you all and all the faculty and staff in this marvelous institution. So we have a lot to cover. On that note, I'm going to go share a screen. We'll see what we got here. And away we go. That's what the title of this afternoon is about. Let's see what we're going to cover. Here's our hoped for agenda. We're going to take a look at the income tax formula just so you're familiar with the words and descriptions of tax issues that I talk about. We're going to talk about the business entity choice, both in terms of tax and some non-tax reasons for making different choices. We're going to talk about the issue of having employees. That could, as I say there, it can be a tax compliance nightmare. That should be interesting to talk about. We're going to talk about keeping records for the purposes of reducing tax, and the R&D credit, the research and development credit, which may be very appropriate for entrepreneurs that are coming out of our University of Maryland School of Engineering and places like that, computer science as well. Then we'll mention something that is of interest of late in the tax code, which may be of interest for the fact that it can attract investors, startup money for your business in a way that may be the best thing going right now. We'll see how Congress deals with this section in terms of tax rates and maybe puts a nix on it in the future, but at the moment it is a wide open Wild West place to be. So that'll be our final topic of the day. So hopefully we'll see that, and that's to keep you interested by leaving the best for last. All right, the income tax formula simplified. Here's where we go. It's not that difficult, but before we look at the actual formula, let's just talk about some basic principles of taxation. Yes, we won't make you tax experts today, but we're going to come close to making you dangerous with the income tax code, which is over 10,000 pages. Nevertheless, all income is taxable unless it is not. So unless the law says something is not taxable, any accretion of wealth, so let's put that down, any accretion of wealth, whether it's in the form of dollars or property, anything that would make you wealthier on paper, give you more buying power, just a greater net worth, is taxable unless the code says it's not. On the opposite end, nothing is deductible unless it is allowed. We're going to talk about what deductions mean when we see the formula right now, but for the moment, let's keep this principle in mind. Everything is taxable unless the code says it's exempt, which are very rare, but there are instances when it may be exempt, and nothing is deductible except if allowed. Here's the formula where we'll get to use these concepts. Here's income. So now we know almost any accretion, any increase in wealth, that's what accretion means, any increase in wealth is going to be included in the tax formula, so it will go right there. However, we get to reduce the tax. We're going to reduce the income to an amount of a lesser amount before we apply the tax rate by the fact that we have deductions. Of course, the deductions have to be allowed by the code, as we said, and we'll talk about what's allowed and what isn't allowed. Taxable income is the result of this little mathematics. Taxable income then is multiplied times the tax rate in order to determine what your tax is. And that's basically the formula, except for one last part, which is there are certain things known as tax credits. Tax credits reduce the tax, and so then you get your bottom line tax liability. Tax credits usually reduce the tax dollar for dollar. So if you have $1 of tax and you've got $1 of tax credits, then you have a 0 in your total tax. Wow, that means that since deductions are reducing tax, but only by the applicable rate, they're only reducing tax by the rate, they're not as valuable as tax credits. That's the general rule. There are exceptions to everything I say today, but for the most part, let's keep in mind that deductions are good. They do reduce tax, but the tax credits reduce even better. So if we're talking about a research and development tax credit, that is better than just a deduction, reduction of tax dollar for dollar. All right, now that I got you thoroughly confused, let's go a step forward. There are some other tax concerns I just want to mention in passing before we get to our main agenda. Let's just talk about them very briefly so that they're said and you're aware of them. That's the main thing. First of all, when you start doing business, it's almost inevitable that you'll be doing business interstate. Today's world, it's unusual to do business just within one state and never cross state lines. So you need to know that once you cross state lines, you're selling either services or product in another state outside of the state where your main headquarters are. You may have a sales tax issue where you may have to collect sales tax on those sales of product or services, depending on the state you're selling in. I mentioned that it's now based on what we call economic nexus. That simply means economic nexus simply means that you don't have to be physically in the other state. Just the fact that you're doing economic business in the other state, you're economically connected to the other state, will bring you into this rule where you may have to collect sales taxes. So you have to look at the state law. If you're in Maryland, headquartered in Maryland, and suddenly you're doing business, service business or sales businesses in Pennsylvania or New Jersey or Delaware or Virginia or even California, you need to look at the laws there to determine whether you need to collect sales tax on the sales of your product or services. Welcome to the big world, even in Washington, D.C. Same thing with income tax in the other states. It's now based mostly on economic nexus. You don't have to have employees there. You don't have to physically be there. And you may have an income tax issue where you owe taxes to the various states you're doing business in. We won't go much further into detail with the state income taxes. We're going to stay with the main federal income tax, but we've now at least put you on notice that there's a lot to worry about with taxation. Okay, choice of entity. The choice of entity is important because you have basically three choices. You can be a corporation. You can do what's called an LLC, limited liability company, or you can be what we'll just call SP, sole proprietorship. Sole proprietorship is the easiest. It's just you. There's no entity that you have to establish. You already are established. You already are alive. It's just you. This one I'm going to cross off because this one has two things going against it. One is it has the issue of if you do something wrong in your business setting, you're liable. And that means all of your assets, all of your future income could be subject to seizure based on the damage that you might do inadvertently, even by accident, in your entrepreneurial business. Corporations and LLCs give you legal liability protection, not necessarily 100%, you can't commit fraud, but in the event that the business makes a mistake, only the assets inside those boxes are at risk. So to do business as a sole proprietorship is a non-starter. That's why I nixed those two. The other reason is that sole proprietorships are not as flexible for tax purposes as a corporation and a limited liability company are, and therefore that's That's reason number 2. Need I say more? With the C corporation, it is a taxable entity, as we'll find out. Here's again, these are the choices. We've narrowed it down to 2. In the what we call PTEs, pass-through entities, you see there's the limited liability company. Limited liability companies can also make an election to be taxed as what we call an S corporation. It's still a pass-through entity. We're going to discuss what this means, pass-through entity, but you need to understand that within the concept of a limited liability company, you have 2 choices. You can either remain just an LLC, or you can elect to be an S corporation. We won't go into detail with S corporations. We're just going to concentrate on the general topic of pass-through entity. Having said that, let's go back to the C corporation and see what happens. It's taxed on its earnings at the rate of 21%. What's exciting about this is a new, very, very low rate for the United States historically. It was at 35% prior to 2018. It's now at a very favorable rate for 21%. Congress, if you've been watching any of the news, is threatening to raise that to 25, 26, or 20, or something higher. We'll see. Right now, it's a very favorable rate. It's very attractive to maybe think about doing business as a C corporation. However, it is subject to a double tax. Let's see how. First of all, it gets taxed on its earnings at the rate of 21%. If it pays out the earnings in the form of dividends, it's subject to a second tax, 20% at the individual level where the dividends are paid. So there's tax number 1, and there's tax number 2. Now, the combined rate of these 2 equals or comes very close to the rate of individual taxation. So it's at the highest level. So it's not necessarily a non-starter for doing a C corporation or being a C corporation. First of all, you have to pay dividends in order to actually even incur the second tax. If you don't pay dividends for a long time, you defer the actual second tax, and maybe you have a setup where you're not ever going to pay dividends. That's possible, that you may never pay dividends, in which case you only have the tax at the 1 rate. So you might say, well, okay, it all sounds pretty good, but I still don't like the idea of 2 tax levels, double taxation. And that's where the LLC or this S corporation, or actually just put it under the category of pass-through entities in general. These don't pay tax. These are not tax-paying entities. They simply have the taxable income reported by the owners, and they pay the tax at their rate. So it's only 1 level of tax, and that's it. And that's the lure of a limited liability company, or the lure of a limited liability company making the election to be taxed as an S corporation, just 1 level tax. So you'll see your dentists, your doctors, your lawyers, your Indian chiefs, many of them will have their name, their license, if they're a dentist, DDS, and then comma, LLC, limited liability company. And now you know why. They're avoiding the double tax of a C corporation. One other key ingredient of pass-through entities, pass-through entity, is that if there's a loss, which in many startup businesses, there's going to be losses. The income may take a few years to generate. Sales may take a few years, maybe under product development for a couple of years. The losses that you incur, if the tax formula is income and that is 0, but you have legitimate allowed deductions, now you have, at the end of the day, you've got maybe a loss, say $100, that goes to the individual tax return. It passes through to the individual tax return, and that can be tax beneficial to the individual. Meanwhile, losses like that for C corporations can only offset C corporation earnings. So you have to wait to see if the C corporation ever has an earnings, and that if it doesn't happen, those losses just get lost. Let me say that again. If the C corporation has deduction, so in its tax formula, it's got a loss, it's not used until the C corporation has profits. And if it never has profits, those deductions are lost. So that's another push for the pass-through entity being of interest to entrepreneurs when they first start off. I would say that most beginning businesses take the pass-through entity route. That's your LLC. So that's sort of favored compared to the C corporation. Forming the company is not a problem from a tax standpoint. There's relatively no issues there. You go to a lawyer, you form it. Generally speaking, it's not a tax issue. However, there's the slide that will tell you that. Usually it was without tax consequences. However, if you bring investors in, you have to be careful about doing that, because if you bring investors in and you become a equity owner in the property that they bring in or the investment dollars, whether it's property or investment dollars, if you become an equity owner with that, then you may have taxation. So you're going to want to see a good CPA to avoid that. If you're bringing investors, it's easy to do. I'm just letting you know that before you start bringing investors in who are bringing money or property or equipment, see a CPA to make sure that you will not wind up creating a tax problem for yourself. Generally, it's not a problem. Same thing for services. Oftentimes, you have a question?
We do, not from my dog though, I'm sorry.
Okay, no problem.
We do.
that was
So we have a question. If my startup has been a C Corp for 3 years with 3 years of losses, can I retroactively convert to an S Corp and pass the losses to my personal income filings?
No, you cannot. They will be frozen at that C corporation level. And if you never go back to a C corporation, you may indeed lose those. There is a way that you may be able to recoup it if you wind up having to, quote, liquidate and you never have profits. Some of those losses may be accruable to you. It depends on the situation depends on the facts and circumstances. But generally speaking, that would not be a good idea. Well, I shouldn't say this. I should say you have to look at what the future looks like. You should do some forecasts, and you probably need a CPA to make that decision.
Thank you. And we have one more question.
Sure.
Can losses from an LLC apply for total income in married filing jointly return, or just one spouse is a part of the LLC?
Yes, and that's one of the major advantages of those losses being able to be used by the owners of the LLC. I'm trying to keep this simple, but it is a great advantage that can be used on a joint return. So while we're there, let me embellish, because I think this is of interest then. Suppose you have yourself and your spouse are working. You decide to open your entrepreneurship. So you stop working, but your spouse continues to work. So there's income showing up on the return. You, on the other hand, you start up your business and you're incurring these typical startup losses. And you're doing it through a pass-through entity. The entity will pass through those losses to the joint return. Now you reduce the tax on the spouse's earnings, because now the total taxable income on the joint return is less. It's reduced by those losses. That is a very desirable tax result. Of course, losing money in your business is not desirable, but if it's inevitable that during the course of its cycle, that's what's going to happen. This is a great tax result in order to be able to reduce taxes while you're trying to start your business. Think of it this way. You're getting a little bit of a government subsidy by the fact that the losses are used against your other income, your spouse's income, or even other income that you have. And so your tax burden is lessened. It makes it easier for your startup.
Thank you.
Okay. All right. So where we last left off is that if you're bringing in investors, just be careful of how you bring them in. You could be taxed for the property they bring in, or you could be taxed for the services. Easy ways around it. Don't want you to get too worried about it. Here we talk about paying people. This is where we get into the W-2 issue. I think what I'll do is I'll just try to brush the surfaces and let you ask questions if you have any, so we can get through all the topics. The main thing about compensating people who provide service to you is to determine whether they are an independent contractor or an employee. There are differences. I wrote 4 differences taxpayers need to know about. We'll talk about those 4. But the main issue is, if it's an independent contractor, you have very little reporting requirements and you have very little tax results other than paying them for their service. If it's an employee, suddenly you have tax compliance issues. You have to withhold income tax. You've got to pay payroll taxes that are on the employer. You've got tax compliance papers that you have to file, and you have to give them a W-2 at the end of the year. Independent contractors, it's true, you have to give them a Form 1099 at the end of the year, but that's about it. This is a whole 9 yards. And there's workers' compensation insurance, there's unemployment insurance at the state level that you have to pay when you hire an employee. It looks like this, just to give you an idea. For every dollar you pay an employee, with the tax burdens that an employer will have, you might as well add 15% to that cost. That's before benefits, before health insurance, before any other kinds of benefits. You might as well add 15%. So it's going to cost you $1.15. With an independent contractor, if you pay them $1, that's what it costs you. So make a long story short, what a lot of employers try to do is they try to say to people that they're hiring at the beginning of a business, you'll be an independent contractor. Here, sign this agreement. It says you're an independent contractor, and it puts the person into this box as opposed to the right-hand side, and it saves the entrepreneur a great deal of headaches right from the get-go. Guess what? That doesn't work unless the person is truly an independent contractor. So the first part of this whole discussion would be to say the following. You got to look very carefully at the rules and regulations. Who's an employee? We can sum it up, but it's a misnomer to say it that this is all it is. It's much more complicated, but we could sum it up by saying, if you control the work that they do, when they do it, where they do it, and how they do it, if you control those things, when, where, how, of the work that they do, and you give them the supplies, and perhaps you tell them you need to, well, we said when, the hours, those types of controls, it's an employee. That's an employee. If the person is truly independent, then you give them the project. You may say to them, I need it 2 weeks from now. They do it 9 to 5 in the day, or they do it 9 to 5 at night. They do it whenever they want. They use their own supplies. They do it wherever they want. They do it how they want because they're independent. That's the difference. Just saying that they're independent contractor by a piece of paper, nada, doesn't work. You can get into big trouble with the IRS if you're ever caught classifying people as independent contractors where they should be employees. Big trouble. You don't want to be there. In fact, the IRS has a formality that allows people who get paid as independent contractors who find out when they go to do their tax return that they've been misclassified. There's a way for them to report you to the IRS. So I don't think you gain much by trying to play the game of calling people independent contractors. I would discourage it. Just the 4 differences that you need to know, which we've mentioned briefly, but just for the record, here's what it is. Let's go through it. Where are they? Here it is. You're going to withhold state and federal income tax from the people. That's what you're going to do. You're going to have a Social Security and Medicare tax burden, and this is the payroll tax burden on the employer. You will withhold these taxes from the employee, but you will have an employer share to pay as well. That's why it's going to get closer to that 15% that I mentioned. You've got unemployment tax on wages, which adds to get up to that 15%. And you've got lots of required forms that you have to file. I'm pointing this out because I don't want anybody to go 2-3 years down the road, find out that they've been classifying people as independent contractors to avoid all this, you know what, and then get in trouble. The penalties can be severe. Okie dokie. Let's jump to deductions. I've got a slide deck here, 40 slides. I'm only going to look at this first one. I'm going to make this available for you all to look at. Inside this slide deck is a list of tax deductions that are allowed by the tax code for purposes of reducing your taxable income as per that formula. Every time you reduce that taxable income times the tax rate, it's less tax that you have to pay. In fact, if the deductions reduce to 0 and below, there's those losses, those net operating losses that we mentioned, net operating losses that can be used against other income on your own return or a joint return as well. So you're going to want to go through this list and take a good look. However, I can make you, watch this, a wink of the eye, I can make you almost savvy enough to know what is deductible without having to look it up on the code. It's never a good idea to say always, so we'll just say a general rule. General rule is that if you need to spend what you're spending on, meaning you have an expense, maybe it's a computer, maybe it's a desk, maybe it's hiring a lawyer or an accountant or advertising or supplies. If it's necessary in your mind, if it's necessary in your mind in order for your business to succeed, even if you're not succeeding today, even if you don't succeed tomorrow, but in your long-term vision, your long-term plan, expending the dollars that you're expending on is a necessary ingredient for success, then usually those will be allowed tax deductions. Quick example, just to give you an idea of how far and broad this concept can be. It's well established that if you buy airplane tickets to attend a meeting of a potential customer, not even an existing customer, a potential customer, or you're buying airplane tickets to explore new avenues that your business could go into, and that's the main purpose of your trip. You can buy first class seats, you don't have to buy economy, and the first class seats can be deductible. You may say, well, why is that? Because if you're in your mind, you need first class tickets to arrive and be ready and be sharp in order to make good use of your time with your potential customer or wherever you're going to explore opportunity for your business, it's deductible. The tax courts basically use what's called the business judgment rule, which if in the eyes of the entrepreneur or the owner, it is needed for the business, it's generally deductible. That's the good news. Okay. Let's talk about the research and development credit. Oops, what's this? Take a look at that. Like I said, you want a good accountant. You want a good accountant who knows that it's not 60%, it's 65%. Ha, ha, ha. Okay. The research and development credit can be very valuable. It's a credit. Remember the formula? You come up with the tax after you've taken the taxable income times the tax rate. If the tax is 100, if you have a credit of $100, if you have a credit of $100, your tax is now 0. So you say, okay, that's great, I understand. But a tax credit is only as good as if you have tax. You can't use a credit if there's no tax. Oh, maybe the credit carries forward, which it does, but I can't use it now. I have to wait until I have tax and I can use the credit in the future. Now, with the research and development tax credit, you may determine that you have a tax credit in the research and development formula. You may find that you have a $100 tax credit. If you have no taxable income with which to use it against, now you can use it in a certain way, and that's what this statement is about. Up to $250,000 per year, you can use your research and development tax credits if you have salaries that you're paying people and you're incurring those payroll taxes. The IRS will give you a tax credit on your payroll, even without income, based on the research and development tax credit. This is a very powerful use of this credit if it applies to you. And that's why we want to spend some time today and see if it does apply to you. So how do you know whether a research and development tax credit is something of interest for you? Well, here you go. Do you make anything? Do you have engineers? Do you have a process of doing your business? And if yes, then you see, you may very well qualify for the research and development tax credit. I will add that if you don't have employees today and you're not outsourcing anything and it's all you in your basement, then the research and development tax credit may not amount to much today. But if you're outsourcing work for people to research something or you're hiring people, this applies to you. Let's take a look at this $250,000 that we are talking about. So again, if you're an entrepreneur and you've hired a group of, let's say 20, 25 people, and you're paying the Social Security tax, that's the employer half, you're paying that, which is 7.65%, by the way. That's the employer half. You're paying that. You could reduce that to zero, depending on how much research and development tax credits you have. The likelihood of you getting up to that amount in a particular year it's pretty incredible if you did. You'd have to have a pretty sizable staff of people and doing lots of research, but it's possible. And this is a great way to make use of the credit while waiting for you to have profitability. That's the important part of this slide, is that the research and development tax credit, which usually gets used when you have profitability, now is available to small businesses on the employer share of their payroll tax burden. So even if they don't have profit, let me give you the theory that the government had that helps you understand what this is about. First of all, research and development tax credits, the theory is, let's give businesses a tax break if they're doing research and development, because it's important for the US economy to be thinking in terms of increasing our technological knowledge. So that's the research and development tax credit to begin with. Then Congress realized that, okay, that's great, but a lot of small businesses don't make any money the first couple of years or even longer. Sometimes it takes 10, 15 years. In a startup pharmaceutical company, for example, it takes a long time to have profit. They're not using the credit. It's not an incentive for them, the credit. So maybe they will be disincentivized, if that's a word, to do the research and development to begin with. So they said, okay, if you're going to have employers and Social Security tax, the employer portion will give you an incentive to do the research, to do the development, and now you can use the credit towards the Social Security taxes, even without income, even without net income. It only applies to what's going to be called a qualified small business. I'm going to walk you through this quickly. So let's do the following. Everybody raise your hand a second, take a breath, because we're going to walk through this quickly. So you got to get that brain ready to rock and roll. Here we go. What is a qualified small business that's eligible for this research and development tax credit against employer shares of taxes? Let's see. First of all, your gross receipts have to be 5 million and less for the year. So that may sound like you. You also have to have gross receipts. So before you have any income whatsoever, this doesn't apply. You have to have some income, and it only works for the first 5 years. So you have to have some income for up to 5 years, then you can use the research and development credit against payroll. If you don't meet this requirement, you can still have the research and development tax credit carry over for future use against income. You don't lose it, it's just not being used today. So there's nothing wrong with if you don't get to use it against employer share of payroll taxes during this first 5 years when you start revenue. By the way, what you could do is in 2020, you could get like $1 of revenue, and then 21.0, 22.0, 23.0, et cetera. And you can still use the credit against an employer share of payroll taxes. You just have to have the 5-year period start with some revenue. So there's probably some creative accountants out there, hint, 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 that can help you make use of this if your situation is you're doing research and development, you've got employees, and you're incurring payroll tax. If not, still do the research and development tax credit for future use against earnings.
We have a few more questions if you don't
Sure,
mind.
go ahead.
So first question, if most expenses are deductible, does this also include cost of goods sold, marketing, materials, etc.? And how would a business ever actually go bankrupt?
How would a business ever actually go bankrupt? Okay, I'll answer that question later or last here. So yes, cost of goods sold, advertising, all those are in that slide deck. You'll see that slide deck's like 30 pages long, 40 pages long. They're all in there. Cost of goods sold, of course, they're all deductible. It's all part of doing business. You can't do the business without paying for or manufacturing the product you're going to sell. So that's that. How does a big business go bankrupt? A business goes bankrupt when this is a legal terminology, when they owe creditors that they can't pay, and they need protection from those creditors against their assets. So it's a way of getting protection against people who you owe money to, so that you can make a better deal. The courts will intervene and help you either get a restart, or they'll help you reorganize and say, okay, you owed 100, Now you're just going to owe 50, pay it off over 5 years. So you may never need to go bankrupt. If your business fails, you may just close up shop. If you've paid everybody that you need to pay, it may be very simple just to close.
Thank you. Yeah. And then the second question is about R&D credit. Are the research being funded by the government grants excluded?
Yes, correct. They are. I believe that's true. Yeah.
Okay. Yeah, because you're already getting money for free.
If the money is not taxable, if it's a government grant that's not taxable, then you can't double dip. So if the government grant happens to be taxable, then it probably would be. It probably would be taxable, in which case you can still get the research and development tax credit. So it would depend on the type of grant, what's actually happening.
Okay. Thank you so much.
No problem. So it applies to for-profit organizations, not for profit. This is a nonprofit tax exempt organization. These entities don't get the research and development tax credit. Let's learn a little bit more about what the credit is. Meaning what work qualifies for the research and development tax credit. Again, we need to go quickly because a good seminar for a CPA in the research and development tax credit could take all day. But we'll get you familiar with it enough that you recognize whether it looks like it applies to you. There's a 4-part test as to what kinds of expenses will qualify or what you need to have in total to be eligible for the research and development tax credit. So we'll take a look at the 4-part test altogether. You have to meet all 4 parts. Let's see what it is. First of all, the purpose of what activity you are doing must be to improve the function or the performance or the reliability or the quality of a product or process. This is where a lot of people forget that the research and development tax credit is available because they're not developing a new product, but maybe they're trying to improve the process of the product or service that they're delivering, in which case the cost to do that, and it could be the cost is you're trying to improve the function of the process or the performance or the reliability or the quality of the process. So it doesn't have to just be the proverbial product. It could be also any one of these. It applies to a process as well. Second part, so that's part number 1. So this is part number 2. There has to be some technical uncertainty, meaning you're spending money either outsourcing with somebody, independent contractor, or your employees. They're working on some improvement of your product or process, yet you know for sure it's going to improve. That's not research and development. You're spending it, but you don't know for sure if it's going to improve. If there's some uncertainty, some doubt as to whether the money you're spending for employees or outsourcing or both will actually improve the product or process, that falls under the category of research and development. So that's number 2. Number 3, there has to be some experimentation required. You don't have to do a control study along with what you're trying to do, but you must be testing that uncertainty. That's what you're doing. You have the uncertainty, and now what you're doing is testing or analyzing it in order to determine, is this the right route that will improve our process or product? Oh, it failed. Let's figure out another way. Even if you have a pretty good idea that the first way you're going to try this should work or might work, as long as there's an element of uncertainty and you have to test it, that meets requirements 2 and 3. Number 4, this is the last part, I promise. The activity needs to be under these categories: technological in nature, based in science. And you can see that even computer science has entered the playing field. And this is where a lot of people are able to put the round peg into the square hole and be eligible for the research and development tax credit in the improvement of software for their product or service or process. So any of those sciences that you see here, but the biggest thing that was the eye-opener for a lot of CPAs to get involved in helping their clients with the research and development tax credit is when they added computer science to the list of eligible, quote, technological sciences that are available for it. So it's great. It's a wide open field. You should really take a good look at it and meet with a CPA. Let's just help you along to know whether there still may be some caveats for you, what activities don't qualify, research activities conducted outside the United States, reason being government's trying to endorse and encourage research in the United States. So outside the United States doesn't work. That will change next year. The research and development tax credit is changing, not favorably for outside activities, but there is some there's some change in the law in 2022, which may allow for some credit for outside activities of the United States. And here you see it can't be just for routine maintenance or quality control. It's got to be for something improvement and processes. You can't use it for survey or polls of people using a product or a prototype. You can't use it just for reverse engineering. Reverse engineering, you might argue of why you can't use it for that is because there's no uncertainty. You know, once you figure out how something was put together, if you now that you can put it together, you know it'll work. So there's no uncertainty there. And it's not for social science or economic research. Sorry for any of you who are there for that. Okay. Continuing along, so what qualifies, just quickly, building new software, new technology, of course, this makes sense, and creating or improving products or services. Here's the list of, not a full list, but a list of industries where it is very typical to find research and development tax credits available. And you can see if you're included in there, and if you're not, don't worry about it. You may still be eligible. These are just to give you an idea. Also, don't forget, or if you don't forget, maybe you never knew, but there are states, including Maryland, that have research and development tax credits as well. So on top of the federal tax credit, you may be eligible for even more for your attempts to improve products. What costs qualify? It's all your payroll. It's all your independent contractors. This is your payroll. This is your independent contractors. Both of those costs go into the credit, and supplies. So you could be paying, this is not atypical, by the way. I have clients that have done this. I have clients who pay parties like the University of Maryland by giving them a grant or giving them funds to do research, and they'll include the costs of that research they're paying the university in their research and development tax credit calculation. So you could give back to the school and still make it a win-win. All right, so what is it? This is just to answer, like, how much is it? It depends on many factors. It's not an easy computation, but you get the deduction of the expenses plus 5 to 10% tax credit on the dollars you spend. So you get the deduction of the expenses that you spend plus a tax credit, 5 to 10%, sometimes higher. If you were in a state like California, this could be as much as 15 to 20% with the state research and development tax credit. So I'm concluding this very brush surface read of the R&D tax credit by saying it can be very valuable. You don't want to overlook it. I said we would save the best for last, and I did. But before we do, let's just again breathe deeply. Tax topics need a lot of oxygen. Section 1202, qualified small business stock, is the biggest thing being talked about right now, particularly for small startups or even larger startups than just small startups. It's particularly valuable because it could attract some interesting investment money. Let's find out why. The whole idea of Section 1202, which is called the qualified small business stock section, is, as you see, like research and development, it's to incentivize investments in small businesses. It's asking investors, please come here and put your money in a new entrepreneurial startup, because look what can happen for your taxes. That's the idea. So what is it? Let's find out more about it. If a person is an investor, let's say, in a qualified small business stock, and they hold that for 5 years, and it may take that long for the business to take off anyway, if it's a startup, the gain on the sale of that stock, which is taxable, will be, based on doing it from today forward, entirely excluded from tax. So you're able to say to your potential investor, hey, give me $10 million, and in 6 years, we're going to be able to sell this company for $1 gazillion. They won't have to pay tax on that gain if they meet the requirements of Section 1202. One more time, how important this can be to attracting an investor. You tell me, I give you money, and you make something with that money, you make profit with that money that will allow us to sell the company 5 years or more ahead of time from now, and I don't have to pay tax on the gain of that sale. That's an incentive for me to invest with you. So if you got a 10-year plan, you're going to sell for a big profit, I could be with you just for the fact that if the business qualifies, then it could be excluded from tax, the gain. So let's just get a feel for what that's, zero tax on the gain after 5 years. Let's get an idea of what it is. Qualified small business stock must be a C corporation. So now you see one of the, maybe not a detriment, but one of the criteria, you have to go back to that double taxed entity. All right, so that has to be taken into consideration. Does it still make sense when you consider the gain that will be tax-free later on? Usually it does, based on the fact that the corporate rates are lower today. It usually makes sense. How do you qualify? The shares of stock that you give to your investors and yourself, it applies to you too, must be acquired at original issuance. So it has to be the stock that's given at the beginning of the business, basically. You have to hold it for more than 5 years. There are ways around, if your business has already been in existence, there are ways around that. You just have to create a new entity and make original issuance stock now. And so that can be done. So don't fret if you're not original. You've been around a couple of years. You can still take advantage of Section 1202. Not difficult to do. The amount of capitalization that you cannot exceed is 50 million. That's the small business definition. It's something $50 million capitalization or less at the date of the issuance of the stock. That's the idea. That's what qualifies as QSB. You also have to be involved in an active trader business, which for most of the businesses that are out there would be. There's some exceptions, which I'm going to outline in a second, so you'll know exactly which do not qualify. But most of your entrepreneurialships and startups are active, or they're active in the sense that they're trying to make money. Even if the plan is not to make money for a couple of years, it still qualifies. It's still an active trader business. You have to elect this treatment on the tax return when you go to sell the stock. That's not a big deal. The amount, look at this, the amount of gain that a single investor can exclude is the greater of $10 million or 10 times the adjusted base of the stock. So if the adjusted base of the stock is $10 million, because that's what they invested, so now they can exclude gain up to 10 times that amount, which is an incredibly large number. And it can go even higher. It's what the maximum basis that you could probably glean from the description. The maximum basis would be 50 million, because you can't have qualified small business stock capitalizations above 50 million. So this probably is the maximum, 50 million times 10 times. If you're lucky to have that much gain, that's how much gain you can exclude from taxation. And here's the types of businesses that don't qualify. These are generally businesses where the principal asset is the reputation or skill of the owner or its employees. So if you're making something, you're fine. Engineering doesn't mean making something here. It means providing engineering consulting services. That's Section 1202. It's the biggest thing on the block right now that CPAs and tax lawyers are talking about, and entrepreneurs, because it can, there's a few more exceptions there, but there's not too many of us doing business in the banking world or the farming, but farming business is, there could be some from a school like Maryland, there could be some farming businesses out there. Unfortunately, that's not eligible for 1202. We could have, you could have a few of these in there. And if we were at the hotel today, you could see that it doesn't apply to those businesses. So these are also excluded. As I said, though, it's the biggest thing on the block with CPAs and tax lawyers, exploring any even already existing businesses where we might be able to fit them into 1202. And it is possible. Okay, so with that, what we can do is we can go to a open forum Q&A. I will make it, while we're waiting for that, I will let you know, again, I'll make the slides available. So anything that I skipped where there was some minutia, you'll have that, and that slide deck with deductions that are available.
Thank you so much. So please submit your questions either in the Q&A function or in the chat, or you can also raise your hand and I can unmute your microphone at this point. So we have a question from David. So this is a follow-up to my last question about deductible expenses. Does this mean that from a tax perspective, if I am making 1 million, I should not owe any tax on that revenue if I buy 1 million worth of necessary things for my business?
Yeah, you'll have a loss. If you don't use the loss all in the year you incur that, you carry forward what you don't use to be used against future income. That's correct. Maybe any other questions, by the way? Otherwise, maybe what we'll do is just run through some of the lists to get an idea what's there. We have a few minutes remaining.
We have another question.
Okay.
When UMD invests in one of its startups, is there any reason the startup can't be an LLC or an S Corp?
There's no tax reason why they can't be. It would depend on the University of Maryland's criteria for what they want to invest in. They certainly can invest in an LLC or pass-through entity as we described.
So the next question is, we are not making money now. When do you suggest we hire a CPA?
Oh, that's a great question. Very good question. If you've already started an entity along the lines that we've talked about today, then there's no, I wouldn't say there's anything immediate, but I would probably do the following. I would probably say you should see a CPA, even if ever so briefly, to make sure you're keeping your records in a manner that will be easy to use for IRS purposes. That you don't want to be keeping records that I don't say get you in trouble, but would be insufficient to survive a tax audit. Tax audits are relatively rare these days, but the IRS has 3 years to audit. So you want to, I would say see a CPA, even like I said, just for a short visit, just to make sure you're doing things right.
Thank you. And just to also remind you, would still need to file a tax return, whether or not you're making money, correct?
Correct. That's correct. Yeah, absolutely. Yeah.
For the purposes of filing a tax return, you have to do it as soon as you incorporate. Whether it's an LLC, it's going to go in your personal, or if it's a C Corp, then you need to file a separate tax return for that.
Correct. The C Corporation is a taxable entity. It has its own tax return. An LLC with only one member goes on the personal tax return. If it has more than one member, there's a separate tax return for that. So the basic answer that I think is what I give to most people is file a tax return, even if for some reason technically you don't need to under the rules of the instructions of the tax code itself. I would still file it just to be on the record.
Okay, thank you. So the next question, if you are incorporated in Delaware and operate a fully online SaaS business, are you forced to register also in the state you have your headquarters? Probably.
There are a few exceptions depending on the state law, but there's not too many. And so I would say the best way to answer to that is most likely.
So you would have to consult your CPA on that, correct?
Yeah, you definitely would. If you're doing business in any state, regardless of where you incorporate it, you're probably going to need to register as what's called a foreign business in that state. They basically require you to register to let them know you're there.
Thank you.
Okay.
Next question. Could you walk through an example of a business investor utilizing section 1202?
Sure. Real life example, make it short, but real life example. We have a client right now who's asked for an influx of capital to start up a business. It's a $25 million angel investor. They're coming in. What they're going to get is they're going to get corporate stock, C corporation stock. What they hope will happen is that the plan is, I'll simplify it. Let's say it's a 10-year plan. They hope that in 10 years, that 25 million will be 100 million. And they'll be able to exclude, when they sell the stock for 100 million, the gain will be, as you see, it's simple math, but the gain will be 75 million. The angel investor hopes that none of this will be taxable at all. It'll be tax-free under section 1202. That's the basic game.
All right, thank you.
Okay.
Let's see. Next question is, if you started as a pass-through, can you change to a C Corp and take advantage of section 1202?
Yes, you probably can. That's the gimmick that I was referring to, that you probably can use that in order to start the clock, that 5-year clock on section 1202. Yeah, you would definitely want a good CPA, maybe a tax lawyer, to be involved with that. But there's a lot of literature going around right now that probably works.
Thank you. And one more question. For a multi-member LLC issuing K-1s to all of the owners, do owners pay taxes according to their own individual tax rates? Yes,
that's exactly right. Well done. Good question. All these questions have been great. That was a well done question as well. That's exactly what happens with the pass-through entity. It does not pay tax itself. It's non-taxable, but the owners pay tax on their own individual return at whatever rate they may have. So each person's on their own. The income is passed through pro rata based on ownership, and everybody's, like I say, they go to their own CPAs and calculate their tax based on their own tax circumstances.
All right, thank you. I don't see any more questions.
Okay.
And we are actually right at time at 2:30, so this is perfect.
Okay.
So I would like to thank Samuel for a fantastic presentation. This has been very valuable, I think, and very interesting. So thank you so much for sharing your time and your expertise with us. Very much appreciated. And
my pleasure.
Thank you to everybody who attended and stayed to the end. And thank you for all of your great questions. That has been very engaging, I think. And as a reminder, we will share the slides and the video will be posted on our Startup UMD YouTube channel so you can review it again. So again, thank you so much. And there are lots of thanks flowing in the chat for you.
Oh, thank you. Thank you very much. Thank you.
All right. Have a good day.
All right. Take care.
Bye-bye.
Bye-bye.